All right, guys, this will be a more surface level. I'll try to keep it surface level. Breakdown rules to trading the New York session, right? And just to give you guys a few insights. This video is not. This won't be the fanciest video. This won't be the most exciting video. This won't be the video that shows you 10,000 ping pong trades. This video is keeping this shit simple, right? This is nothing that I created. This is only something that's been discovered, that's been delivered. And I want to help emphasize that, we can make trading simple, right? We don't have to go and find and jump down a bunch of rabbit holes to make money in the trading space, right? So if you're watching this, you probably already understand the ICT kill zones and things of that sort. Whereas the London Open kill zone is from 1 till 5 a.m., right? Primarily, I use 2 to 5 a.m. And the New York Open kill zone is from 7 until 10 a.m. Primarily, I use 8 until 10 a.m., right? Now, with that information, okay, what we can do is, as traders, right? If I say that, hey, I only trade the New York session, right? Now, there's a plethora of variables and principles in regards to the ICT trading space, right? We understand a lot, okay? And a lot of times that can lead to cognitive dissonance, right? Where we're seeing so many things, we're trying to process so many variables, right? And we're just firing shots away, all right? So I pose this question, all right? Who would you put your money on, right? Are you going to put your money on the sniper who has ideas his target, right? Who's locked in and focused on his target, right? And he's waiting on the perfect opportunity to fire, right? Or do you put your money on the gunslinger? He has a target to hit. However, he's firing at anything that moves. All right, it's basically hit or miss. I would much rather place my money on the sniper, right? So this video is, I guess, an introductory to what that actually means, okay? And what that means is defining your stage, your setup, your pattern, your time, whereas you come into each day and you're not just looking at any opportunity, you're not just looking for trades, you're looking for characteristics that align with your system, and then you trade, right? All right, so a few key components in terms of rules to New York trading. It's just understanding the midnight opening price, all right? If you're a newbie or a beginner to this stuff, midnight opening price would be 12 a.m. midnight. CME open would be 8:20, right? Which is CME is the Chicago Mercantile Exchange. Sorry if I'm saying it wrong. Understanding daily bias, right? Where's the draw of liquidity? All right. Whereas, in terms of, and it's more than just the draw of liquidity, right? Yeah. Understand the draw. You didn't understand the power of 3, accumulation, manipulation, distribution, right? Understanding the relationship between each session. Of course, draw of liquidity, I've already stated that. Understanding the weekly range expansion, and then also the PD array matrix, which is highly important to what we're going to try to accomplish here, right? So for this video, we'll just focus on stage 1, or what I call stage 1, and stage 2. All right. So I'm not here to recreate anything. I'm not here to rename anything or take the place of anybody, right? I'm just here to give you guys insights, okay? Because this market has been printing longer than what a lot of people have been teaching, right? Okay, so the ICT classic buy template, all right, is sort of what stage 1 defines, all right? So stage 1 is primarily a classic buy or sell day, where New York is typically a continuation of the London expansion, right? So about 80% of the time, if you go back, you back test, you look at charts, you'll see that 80% of the time, and this is just a rough estimate, okay? 80% of the time, you're going to see if London gives you an expansion, right? And, the ADR is not exhausted, all right? And there's still an open draw and we're trading, and that expansion is in line with the weekly range expansion, right? That sets the stage for a New York retracement and continuation, which ICT calls optimal trade entry, right? And so now, of course, additional rules and framework are to be applied, which I kind of mentioned some of those things, understanding the weekly range expansion and things of that sort. But just to take a look at the ICT classic buy template, you can excuse this stuff. We don't have to even worry about that. Let's just say that we're simply understanding that New York is a continuation of London, right? We're not taking into account anything else except New York is primarily a continuation of London, right? So what that looks like is London opens, right? It has a Judas swing, right? Maybe it sweeps the Asia low. Maybe it runs through the Asia midline and sweeps some type of internal range low, right? Biggest point here is we want to see some type of expansion from point A to primarily point B. All right. Now there are specific times that we'd like to see that point A and point B set, which is what we'll teach, in the actual boot camps. All right, to kind of solidify it a lot more, to give you a better focal point to know, okay, cool, this is the day where I'm probably going to get that OTE, right? And then when those times and the disparity between those time windows don't align, all right, then you automatically know, right? It's just that reticular activating system. You automatically know, all right, this is a day where I need to adjust and I'm probably going to get stage 2 or stage 3. All right. Now, and the other piece to this is after knowing that, hey, New York is primarily a continuation of London, right? The other piece is we're studying the PD arrays within this range, okay? And based on those PD arrays, so we'll go premium and discount. This isn't drawn to scale, but we'd imagine this is premium, this is discount. Price is trading back down into discounts, all right? And we're looking at maybe there's a breaker here, right? And maybe there's some type of fair value gap that aligns right here, right? And lower time frame liquidity pools, okay? Now, where if the X comes in, right? Where if the X is what we've mastered is the ability to not need a market structural shift, all right? The ability to understand that before the market structural shift, right? Or even this, the change in state of delivery occurs before that, right? The change in state is what leads to the market structural shift, okay? However, for the sake of this video, we'll only focus on just rules to the New York session, surface level rules, all right? So what I've done here is I have quite a bit of examples, right? Most of these examples are literally from 1 month of trading, one pair, all right? So we have stage 1, once again, stage 1, all right, which is primarily a continuation of London, and then we'll look at stage 2. So if we look here, right, this white line is marking off the midnight opening price, okay? And these are all textbook scenarios, right? But think about it. That's all we want to trade is textbook scenarios, right? Textbook scenarios are hell yes scenarios. We only want to trade when when the market is giving us a hell yes opportunity, right? No 50-50s. All right, so here's a situation where we have London, right? Judas swing taking out the Asia low, right? Here's an expansion, okay? Now this red line to the gray line, this is marking out New York open kill zone and then the London closed kill zone. Some of these will have some of these will be slotted differently because of the specific times that I trade the kill zones. But a few others will actually have from 7 to 10 a.m. But anyways, here's an expansion, right? Now, once we get that expansion and we start approaching New York, all right, we begin to look for New York to creep back inside of the range that London has created from point A to point B, right? Once we have this and you wake up, you have this, right? Now you've ID'd a pattern, you've ID'd a stage, right? And a setup that yields you a high probability of having a successful trade and choosing the right direction, all right? So once we have that, right, we want to look inside of this range and we want to start marking off our PD arrays. So, and then the next thing we also want to do is you want to measure, right, and you want to find that OTE, right? So if you're not familiar with OTE, all that means is price is coming to at least equilibrium, right, and below. Okay, so you measure that range, premium and discount, right? There's a low, there's a high. We have that expansion. We want to see price coming to discounts, or at least to premium, to equilibrium, before giving that second expansion. All right. So here, right, we have a bit of a swing low here on the lower time frame. We can measure from that low to this high, right? I'd imagine that equilibrium is about right here, right? We have our premium and discount. We can see price has engineered short-term lows, all right? And we got to understand, if you saw if you were fortunate enough to watch the other free video that we send out, which talks about the dealing range, right? Well, you got to understand that price engineers, right, and then neutralizes, right? So those first two steps is what starts what we like to call a high probability pricing sequence. Okay, so when we're looking for that retracement back inside of the range, we want to see price engineer and neutralize, right? Or we want to see short-term lows taken out, right? And basically, we're prepared to enter after we see that intermediate term low form. All right, now, of course, we have a very objective sequence of things that happen on a much lower time frame to confirm our entries. All right, it's very precise, probably one of the most precise things that I've been able to kind of discover within the market, right? I didn't create it, I only discovered it, okay? But anyways, right here, we take out short-term lows, right? And we get that expansion, okay? What you can also do is, in measuring this range from low to high, right? You'd have fib extensions, right? I may go to a chart just to make this clearer. You'd have fib extensions. So you may have 0.25 here, and you may have like a 0.5 here, right? But it's not to scale. But anyways, when you have those extensions, right? If those extensions align with a liquidity pool, right? Then you also notice that about 75% of the time, excuse my statistics, about 75% of the time, price will run right to those extensions, which are only deviations. All right. And if you understand that price is delivered by an algorithm, right, then those mathematical expansions, right, or calculations are going to be ever present within this market. Okay. Let's go to the next example. Right here, same idea, right? We wake up, here's midnight, right? If we're coming to the New York session, we see from point A to point B, there's been an expansion, all right? From that expansion, as we start approaching the New York Killzone, right, we see price slow down and we see price start creeping back inside of the range, all right? So we can potentially take that high to this low, right? We can measure the two, or you could take this high and that low, all right? Understanding that that's a PD array. Okay, you can take those levels, you can measure premium and discount. All right, you're just simply looking for price to come back inside OTE, right? And then we're looking for that expansion. Okay, one other key point in terms of this New York session, right, is got mentioned above. We talked about the CME, right? 820 opening price. All right, now to give you insights, the 820 opening price, right? Let's imagine we have the midnight open. And typically, if we're short, we want to be short above the midnight open price, right? Now, if price is already expanded well under the midnight opening price, well, we don't have the luxury of seeing price come all the way back up here and then all the way back down here, right? So then what do? We recalibrate and we use the 820 opening price, all right? So if I can look at this image here, 9 a.m. is here. I'd imagine this is 7:30. I'd imagine 8 o'clock is here, right? So I'd imagine 820 has to be around here somewhere, all right? And what you can see is we're getting above that 820 opening price. We've engineered something, and then we've also neutralized, okay? Our entry model places us into this market somewhere around here, right? As the order block is being created, okay? Let's go to another example, right? Look at this example here, right? So here's an expansion, right? Within the London session, point A, point B. As we approach the New York open kill zone, we begin to see a decline or a retracement back inside of London's range. From there, what we have to do is we have to look for our PD arrays, all right? So we measured premium and discount of this range. We'd have an old low, right? We could consider this our breaker, right? Or you can take this whole range, to be honest with you, because that's up. We're taking out short-term highs, take out short-term lows, and then we expand. So this whole area would primarily be a breaker. What we can do is we can split that area in half, right? And then we see price coming down. So basically we're inside of a PD array, all right? And then from there, right, this is where if the X comes in, because it's almost like, well, how do you know that price is going to turn around? You don't, right? You have to, instead of guesswork, instead of just placing a limit order entry, you know, because if this range has multiple PD arrays, how do you know which PD array price is going to turn away from? You don't. The PD array, all right, PD array is only a means of potential, meaning that it provides potential for price to change its state of delivery or to change its current state of order flow. Well, how do we confirm that? Confirm that by the model X, right, which is the entry model that we teach. Okay, and once again, it's super objective. I can't stress that enough. Here's another example here, right? Asia, have a Judas swing, taking out the Asia low. We have an expansion. That's point A. That's point B, right? Well, now I'm going to study point A and point B. I'm going to look for my PD arrays. I'm going to go premium and discount. Here's a PD array here, bearish order block, right? Price runs to that bearish order block. I want to see something engineered and then neutralized, right? We engineer liquidity here, we neutralize it here, right? Biggest point, point A and B, this would be our optimal trade entry. Once again, we're not just taking a blind limit entry here, all right? Lower time frame is going to tell us the very moment that that institutional order flow changes around, right? But anyways, you catch this trade, right? Maybe you take the profit at those equal highs, right? And then there's also your 820 opening price that we come back and go below, okay? And you can also see here, bodies of those candles don't go above that 820 opening price, all right? So the 820 opening price does have a purpose. Here's another example here. Actually, are those the same? I think those two might be the same examples. Yeah, they are. Okay, let's go here. All right, we can look at this example. Okay, we have the Asia session, right? So here we go. One more run higher, and then we go here. All right. Biggest point in looking at this is that when we arrive to New York, there is an expansion from early in Asia to just before the New York open kill zone. We retrace back inside of London's range. This may be news here, right? However, this is still OTE. New York is being a continuation of London's direction, right? So now think about waking up every day, and instead of just waking up not having a focal point, you wake up and you actually have a focal point, all right? And you know what you're looking for, okay? So you've already basically answered 50% of every trader's problem each day, which is figuring out direction, all right? Here's another example here. You open, you have a bearish expansion in the London session. Just before arriving to the New York open kill zone, we begin to creep back inside the range. Now, right here, right, there's short-term highs here, right? Price runs those highs out. We can measure from this high to that low, okay? We take that range, we look at our PD arrays, all right? Obviously, we have an order block, fair value gap here, all right? Price trades into that area, all right? price trades into that area. And instead of taking a blind entry, right, we take our entries after a change in the state of delivery here, right? After institutional order flow is confirmed in the lower time frame. Okay. You can do the same thing here. OTE, biggest point, London's expansion was here, New York's expansion is here. All right. And then you can see the offset during the London close Killzone. Another example, same ideas. All right. This is going to get very repetitive, but in trading, we make money when shit is repetitive, right? That's where our edge comes from. When we find a system and something that we can wake up every day and the shit becomes boring, right? Basically, we start feeling like a robot. And that's what makes money. Okay. Then expansion, London. Here we are, New York open kill zone, start creeping back higher. Optimal trade entry, continuation. All right. Let's go here. Same ideas. Here's the London session, Judas swing above Asia. We have expansions. This black line is marking your 7 a.m. opening price, right? 7 a.m. We have a little inducement. Come back inside the range in the New York session. All right. Let's see if we can, I didn't mark the 820 opening price on this. Let's see if we can find it. If that's 7 a.m., this is 10 a.m. The 820 has to be, 820 has to be somewhere in here, right? Obviously, we're above the 820 opening price. This line here is marking 8 a.m. Right? It's a 15-minute chart. That means 820 is somewhere around here, right? Biggest point, once again, is we're getting above that 820 opening price, okay? And we're trading lower. Instead of taking a blind entry, because at this point, you'd have to go through this range and say, hey, where are my PD arrays? Premium here, discounts here. All right, well, you have an old high. So you have order block, old high, rejection block, so on and so forth. All right, biggest point is when price arrives at that array, what tells you other than guesswork that price is going to turn around? So you don't know that price is going to turn around from a PD array. All right, we don't know that. You know that when you go down to that higher time frame and you start thinking, instead of trading the PD array, which is a key level, we trade the response from the key level, right? So we'd be trading the response up here. We're not trading that, we're trading that. All right, there's a complete difference. Let's go. Second. All right, another example. So obviously you can see above right here, here's your Asia session. London sweeps the Asia high, Judas swing. We have an expansion, right? And before we approach the New York open kill zone, 7 a.m., we've already started to creep back inside of London's range, all right? You can see optimal trade entry, all right? We'd be looking for our PD arrays, right? We have this liquidity void here, all right? Price trades higher. I'm sure there has to be a low over here that, or some type of point of fair value that price finds. And then we begin to trade lower, all right? You can also see here from this little expansion, the 820 opening price is here. We get above 820 opening price. And then we have reaccumulation of shorts, and then we go lower once more, or redistribution of shorts, right? Another example here. I told you this was going to be boring, right? Here we go, Asia session, right? We have we don't have a Judas swing above the Asia high, right? However, this can be considered a Judas swing. We have a short-term high here. We run above that level, all right, and then we displace lower. Just before we approach the New York open kill zone, we start creeping right back inside of London's expansion. And although this is not a bearish expansion that extends for the entire day, right? Ask yourself, are you able to make money on this move? Yes. All right. Price creates these short-term highs. It liquidates those short-term highs. Now you need to know how to actually enter and execute beyond just saying, hey, there's an order block, I'm going to trade at that order block. You don't know that price is going to be held at that order block, right? You have to then move from trading the key level to trading the response. Right? I think we already watched. No, maybe we haven't. We didn't look at this. But anyway, same idea. You guys get the point, right? Judas swing above Asia. There's an expansion. Price moves back inside of the range, right? 820 open, price is here. Obviously, this is news. Biggest point is we have a continuation from the London expansion. Right, same ideas. Judas swing, expansion, that's point A, that's point B. Trading back inside the range, right? We'd be taking this range and looking at our PD arrays. Obviously, price trades here, trades there, trades here, trades there, right? We have a breaker right here. Price comes to that breaker. However, how do we know that price is going to trade from that breaker? We don't know that, right? Nobody knows that it's going to turn around from that breaker. Think about the current state of institutional order flow as price trades from here to here. And then that order flow is going to change. Okay? Need some type of entry model instead of just taking a blind entry. Another example is Asia, right? We don't take the Asia high. However, we basically induce this high that was created in that protractionary period after midnight, take that high, and then we have expansions, right? That's point A, that's point B. Trading back inside of London's range, right? Right around London closed Killzone, we have an expansion that takes out that one. Okay, OTE, premium and discount, right? We look for our arrays, right? We could just say this is our mitigation block. Failure swing here in displacement. Price trades into the mitigation block. It engineers short-term highs, neutralizes short-term highs, expands lower. Right? So that's it for stage one, right? Remember, it's just all surface level. That's it for stage one. As mentioned, it's basically just a classic buy day or classic sell day. All right. Now, stage two defines primarily a swing to reversal day. All right. So if you think about what a swing to reversal day is, that's typically where, you know, London will open up, have that little inducement, it'll set the intraday low, and then it'll have an expansion. And as we approach the New York session, which is why this template is called a swing to New York open, London close reversal day, because as we approach the New York session, London will have already made its way into a higher time frame PD array, primarily a daily, weekly, or monthly buy side or sell side liquidity pool, right? And then of course, additional rules and framework are to be applied with this, which we'll teach in the next boot camp. All right. So if you look here at this image, okay, we have the London session opens, have this move here, right, induces that low. We then trade back higher, right? And as we open up in New York, we've already made it to a previous day's high, right? So the objectives have been met. So ask yourself, are you really anticipating a continuation in London? No, because objectives have been met. I mean, in New York. Primarily, when we're trading New York, we're trading New York because we believe price has more objectives to get to. All right. In this case, the objectives have been met. We're going to anticipate that New York is going to oppose London's direction. Okay. And then so once again, how do you know that price is going to turn around? Order flow, algorithmic principle, understanding a high probability pricing sequence. Okay. It's the same rules every single time. Nothing changes. I promise you. Same idea here, right? Our entry model forms on this day, right? It's literally right here. Same steps every single time. However, this would be the, here, London session, a little bit of a Judas swing, rallying higher. And as we approach New York, remember this red line is 8 a.m., 7 a.m. is probably right here. As we approach New York, we've already taken out a previous day's high. Do I really expect London to be a continuation, right? So remember that 85% or 80% chance that New York is a continuation. Whenever we make it to a previous day high, previous week high, or just a higher time frame liquidity pool, this drops off, okay? And then we start to think smart money reversal. All right. So that's what we got. This was maybe 2 or 3 Thursdays ago, right? Today is August 10th. Then we got that reversal, right? So once again, this is a London swing to New York open, London close, reversal day. All right. Same idea from that one. I don't have many examples of this one just yet. So this image, this one here should have been above, but this is a continuation day. London expansion, right? This was CPI about 2 weeks ago, or FOMC 2 weeks ago, right? All we did was just we consolidated because of FOMC, and then we took out those lows and expanded. However, optimal trade entry. All right, but sorry for that image being there. Okay, here's another example of the London swing to New York open, London close reversal day, right? So we have this rally, price comes higher. Now we understand that price has taken out the previous day's high. Make sure that's not the same. No, that's not the same. What's the date on this? 5/16. I want to make sure I'm giving you guys multiple examples. Right, 5/17. So actually, yeah. Okay, cool. Yeah, these are different days. All right. But anyways, we have a London swing, right, to a New York open, London close reversal day, right? Intraday low is set. We get to New York, and I have to ask myself, do I really expect for New York to be a continuation of London? No, I don't. And look what you can do. Points back to optimal trade entry because you get that expansion. Guess what? On that swing day, price primarily takes out the intraday low. So if that intraday low is still open, I can think OTE or continuations. All right. So that is that. So then we have stage 3. Stage 3 is basically a hybrid type of day. All right. Where the profiles aren't as clear as when we wake up, and majority of the days where there's a London consolidation, right? There's not a huge disparity between or a huge expansion in London. We then have to use our understanding of dealing ranges and balanced or efficiently traded price ranges to then trade that New York session. So that is all I have for this session, right? I hope you guys can take something for this from this. Once again, I know it's very surface level, but that's why you want to be a part of it, the X, and we'll basically give you those enhancements to then be able to go in and have a lot more to work with. And then also once you get that perfect stage and setup and pattern, right, then that moves into how do I now execute, right? What tells me to execute beyond seeing a PV rate? What tells me to execute, right? And that's the high probability pricing sequence. All right, so hope you guys enjoyed this video. Hope you learned something, and hope to see you in the boot camp that is to come here very soon. Thanks.